And good morning from Prague here at CTP with update on the first half of 2025, which has been so far a very good 6 months. We at CTP say change is opportunity, and we have seen many different changes over the past years, and that has been good for our clients and our business. Yeah, we see trends of deglobalization to continue, which triggers nearshoring in Europe for Europe, and then in Europe for Europe. It's often Central Europe where companies land. Those are companies from all over the world, but also Asian companies, which is now good for more than 20% of our new business. Most of the new business we continue to do for existing clients, long-term loyal partners who we have built facilities for over the past decades in different countries throughout the CEE, region of Central Europe. And we continue to do so. So we get still more than 70% of all the business we do from our existing clients. But it's very good to have new companies come in as well. Many Asian, in particular, Chinese companies who have found their ways to Europe in order for them to grow their business and supply their European clients. So that has been good. In numbers, so we've seen 1 million square meter of new leases, which we've signed first half this year. 1 million square meter is 11% more than we did during the first half of 2024, 11% up. And we've also been able to sign those leases at higher square meter prices, around 5% more compared to prices of 2024. And looking forward, we continue to see strong leasing activity. It is often the case that we close more deals in the second half of a year, so we are positive about the rest of 2025. Clients are happy, tenants are happy. Retention rates continue to be 85%. Collection rate, that means the money we collect from the tenants, close to 100%, 99.7% of all the rent we charge, we get paid from our tenants. So they are very strong, financially healthy companies who grow. City Park model, so our unique business park concept continues to grow and is very successful. Mostly grow with existing clients and the companies who have been here who continue to grow their business, and often, in some cases, started as low-cost manufacturing, turned into a full-scope facility with R&D in-house and logistics facilities. So it became real big. We break it down at CTP. We talk about operator. Operator is our portfolio of income producing. We are at 93% occupancy, same to what we were before. We've been historically around 95, 93 at 6.2 years of WALT. That's the current figure. We have a portfolio now of around 13.5 million square meter. 13.5 million square meter is good for 757 million euro of rental income per year. That's the 13.5 million square meter portfolio, which we have built mostly. I think 80% of that is constructed by ourselves, and we have then also acquired some portfolios here and there as part of an entry strategy in a new market or in order for us to grow our market share, which we continue to do. We have around 1,500 different tenants in all those buildings, so that's good. And these buildings are well maintained, they're all BREEAM certified, and we look after those properties as if they were ours, which is the case. So we continue to invest to make sure that parks and buildings remain in excellent condition. That means we continue to invest in infrastructure, access to our parks in green areas, adding amenities and facilities to those parks to make sure that parks remain attractive. And often, I must say, become more attractive over the years because you're adding more companies and facilities and amenities. And then these parks grow and then become a center of activity and business for local communities. Obviously, also we team up with schools and other stakeholders, which is good. So you provide education as well as workforce to those clients in parks. And we add incubators, smaller units. So I think there's more opportunities to build these SBUs, small business units, in different markets, especially in Germany, but also in the Czech Republic and other markets. Often as a part of a business park, could also be standalone sites where we develop, 30,000 square meter of SBUs in one location. That's what we're looking into. And maybe that's also the jump to the developer. Our second activity, that's the in-house construction company. We build a lot of stuff. We have on the way more than 2 million square meters of projects currently. Some of that will be complete this year. So far this year, first half, we've completed and handed over around 224,000 square meters of space to our clients, fully leased. And the other properties, most of the 2 million will be completed during the second half and handed over to the second half of 25. And some projects will go into 26. Interesting, I think important to mention is that almost 80% of those projects and developments are within existing business parks. So those are parks which we started, where we bought land, built infrastructure, and we continue to add buildings and build buildings in those parks. Why is that so important? Well, it confirms the success of a park. You already own that land, you have done your infrastructure, so it's very nice to continue add and grow those business parks to become a full-size business park. And that's what a park is about. You continue to add companies and different industries to diversify also. When this 2 million is fully let, it will do another 160 million euro of rental income. And we will be around 10% yield on cost as we typically do. The people at the construction teams do value engineering and procurement, of course, but also make sure that we build the right quality for the right price, which then helps us to get to a 10% yield on cost. Upon completion, we think these buildings will be 80-90% leased. We start and then we continue to build. And most of when we start, we have a pre-lease for part of the building or for all of the building. And we build a bit of speculative here to also have an opportunity for companies who need something soon. We have something on stock, as we say. But typically we then get to over 90% once buildings are complete. Czech Republic, our home market, and very strong. I must congratulate the team here in Czech Republic. They do a fantastic job. Jakub Koller is at the helm of CTP Czech. He's done a great job. And he's been with us for a couple of years now. He started as a leasing guy and turned into a proper country head here. So congratulations to Jakub and his team for the fantastic achievements so far we have seen in the Czech Republic. Multiple projects on the way throughout the Czech Republic, in particular in Brno. CTP's home market, you could say, where also we do things for Hitachi. We're doing some things for Gerrit, for Honeywell, for other long-term clients. And at the City Park Brno, which is a flagship business park, where we also now have more engaged the city, but also the university and the high school, which is good. It's, I think, next level business park. It's also a little bit of a kitchen, maybe Brno, where we develop and invent new property types and new things, which is nice to see that the Czech teams continue to do that. That's good. Poland is good, strong, good demand. Piotr Flugel and his team started obviously much later in Poland compared to Czech. Czech we've been since the launch of CTP in 2000. And Poland also only came a couple of years ago with an acquisition of 7R, a friendly local developer, which we knew. We bought most of their land bank with some projects they had on the way. And Piotr Flugel and his team turned it into a development machine. And they continue to do one after the other side. So they currently we have more than 100 people in Poland, in Warsaw, with offices in Poznan, in Katowice, and in Gdansk as well. That's good. And the Germans getting there, nice team. I seem to spend a lot of time with them. Two things we do, two business lines. The Deutsche Industrie, which is the portfolio of properties we bought a couple of years ago, 1.6 million square meters with many, many, many tenants. That is a very different business to our normal new build stuff. We do both at the moment. So we have a couple of sites which are magnificent, are really nice, beautiful opportunities which we've been able to buy because we felt that the market was good to buy in Germany in the past years, and that resulted in us buying a site in Mülheim, in Düsseldorf, but also in places like Aachen, Krefeld, etc. for our new developments. And we have been able to start. So we're under construction in multiple sites, more than 20 locations throughout Germany where we actually are either constructing or about to start construction, which is a mix of SBUs, so small units, 1,000 square meters with a loading dock and a door, a showroom, a little bit of a workshop or warehouse in strategic locations, but also custom build and warehouses all together. We've done some announcements on Mülheim, and we'll continue to do other announcements, so it's good. And that is also our core business going forward. At the same time, we look after the Deutsche Industrie, which we bought for cheap at that time, but also we need to do refurbishments and rental growth, which we have been able to do and continue to do. And now also with the new government in place, you see a change going on in Germany, and that results immediately in more demand for both Deutsche Industrie as well as our new developments. So quite positive about Germany. Yeah, fantastic group of people based in Wuppertal. Most of them, not all of them, more than 100. And I continue to go there every second week. We see more opportunity in Germany. Also good to see that some of the tenants we have in Germany are also active in other countries in Central Europe. So there's also a good opportunity to work with them more, to build on those relationships and grow the business together. That's for me so far. Thanks for dialing in and for your attention. I'll hand over to Maarten and of course remain available for any questions you may have later on. Thank you.
Moving on to the financial highlights. The like-for-like rental growth came to 4.9% in H125, driven by indexation and strong rent reversion. Occupancy at the H1 remained stable at 93%. Our gross rental income increased by 14.4% year-on-year to 367 million euros. And we continue to reduce our service charge leakage, bringing the NRI to GRI ratio to 98.1%. Annualized rental income increased to 757 million euros, illustrating the strong cash flow generation of our portfolio. And we confirm our target to reach an annualized rental income of 1 billion euros by 2027. Company-specific adjusted EPRA earnings increased by 12.2% year-on-year to 199.3 million euros. And CTP's company-specific adjusted EPRA earnings per share amounted to 0.42, an increase of 6.2%. The lower year-on-year increase in the earnings per share is driven by the increased number of shares as a result of the equity raise in H2 24. But thanks to our backloaded deliveries and net development income in the second half of the year, the group is on track to reach its EPS guidance for the year. And we expect to return to double-digit EPS growth from 26 onwards. Now looking at the valuation results. The valuation results in the first half of the year came to 598 million euros. Of this, 181 million euros was driven by the construction and leasing progress on our developments, while 374 million euros came from the revaluation of our standing portfolio and 43 million euros from our land bank. Our standing portfolio saw an average 11 bips yield compression, while the ERVs increased by 2.5%. The total gross asset value now stands at 17.1 billion euros, up 7.2% from full year 24 and 15.9% year-on-year. CTP's reversionary yields stand at conservative 7%. And we saw yield compression in the first half of the year, but we also expect both further yield compression and positive ERV growth in the CE region in the second half of 25. In most CE markets, inflation-adjusted real rents remain lower than 15 years ago, illustrating both the affordability of the region for our tenants as well as the midterm rental growth potential. This is also illustrated by the new leases that we signed in H125, where rents were 5% higher than the new leases we signed in H124. This is also supported by the undersupplied nature of the CE markets, with only half of the industrial and logistics space per capita compared to UK or other Western European markets. We also saw transaction markets reopening across Europe, as there is more clarity around funding cost. And especially on the private equity side, that's funds coming to their maturity, we expect to see more churn. This will further support our valuations, but as well offer opportunities for us. Our EPRA net tangible asset per share increased from €18.08 at year-end 24 to €19.36 at the half year, representing an increase of 7.1% since the beginning of the year. Year-on-year, the increase was 13.5%. With this NTA growth and our dividend, we delivered a total accounting return for our shareholders of 70% in the last 12 months, highlighting our superior return profile, which is unique for the real estate sector. And now I hand over to Richard.
In the first half of 2025, we secured €1.7 billion of debt to fund our organic growth. We issued €1 billion of bonds directly after our full year 2024 results, seizing the market opportunity of very attractive pricing ahead of the tariff announcements and the subsequent market turmoil. In addition, we closed our inaugural Samurai loan of 30 billion yen, the equivalent of €185 million. Diversifying the sources of our funding is one of our main priorities. We transformed CTP from a purely euro senior secured financing structure in 2020 to a largely unsecured financing structure through bonds, private placements, and unsecured syndicated facilities, consistent with our stable investment-grade rating. Adding the Japanese yen market to our funding mix further improves our position, as the Japanese yen market, which is the world's third largest, is competitive at different times than the euro market. Finally, we signed a new unsecured facility of 500 million euros in June, which we drew down in July. We continued to actively manage our funding costs and negotiated margin reductions on 159 million euros of loans. In total, we have renegotiated or repaid over 1.5 billion euros of our most expensive bank loans in recent months. This includes the prepayment of the 441 million euros of expensive unsecured debt in H1 of 2025. The 272 million euros of bonds which matured in June were repaid from our available cash, and our cash position stands at 800 million euros. When including our 1.3 billion euro RCF and the new unsecured loan drawn in July, our pro forma cash position stands at 2.6 billion euros, more than sufficient to meet our cash needs for the next 12 months. The average maturity of our debt stands at 5.1 years, with only 254 million euros of debt maturing in 2025. At the end of the second quarter, our average cost of debt came to 3.2%, slightly up compared to year-end 2024 due to the new funding. Our current marginal cost of funding is close to 3.5% for 5-year money. And thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of over 2.4 times, while our normalized net debt to EBITDA remains stable at 9.2 times. We expect the ICR to have bottomed out. As we showed during our Capital Markets Day last year, thanks to our market-leading development yield on cost of over 10%, each euro we invest in our pipeline increases our ICR and decreases our net debt to EBITDA. Our loan-to-value decreased to 44.9% from year-end 2024, mainly thanks to the positive revaluation of our standing portfolio. We remain confident in the outlook for CTP. Leasing is strong. We see nearshoring speeding up in many industries, with production in Europe for Europe continuing to drive demand. Our pipeline is highly profitable and our growth is tenant-led. Thanks to our industry-leading yield on cost of over 10%, we're able to deliver sustainable and profitable organic growth, while maintaining our strong financial position. We confirm our EPS guidance of 86 to 88 cents for 2025, representing 8 to 10% growth compared to 2024. We expect to deliver 1.2 to 1.7 million square meters of developments this year, in line with our long-term growth targets. Thank you for your attention. We now welcome your questions.